Hello friends, in this session we will discuss the Unit 6 of Bank Finance Management, risk in the foreign trade and role of the ECGC. So friends, see here, in international trade, we know in international trade there is importer in one country and there is exporter in other country, right? So there are different countries involved, right? There are two different countries, so there will be more risk. There will be more risk because two importer and exporter, both the parties are in different countries and there may be a different political scenario. There may be a different political scenario. That's why in international trade there is more risk. There is a more risk. Okay. So friends, we have already discussed different types of the risk in our first chapter. We have discussed different risk in the foreign currency exchange. Okay, now here we have to discuss some more risk which are mainly in the international trade, that is import export business, and how we can eliminate the risk. By the way of insurance. By the way of insurance we eliminate the risk. And in the international trade, to eliminate the risk, to minimize the risk, the ECGC plays an important role. How? See, the ECGC provide insurance. ECGC provide insurance for the exporter, to the exporter, for the export business. Also, ECGC provide insurance to the banks in India, who finance to the exporter. Okay, so what is the role of ECGC? To provide the insurance. To provide the insurance is the role of ECGC. Okay, so in this session we are going to discuss two parts. Very first, we come to know that ECGC provide insurance. ECGC is providing insurance to whom? First, it provide to the exporters, and second, it provides to the banks who gives finance to the exporters. Okay, so in this session we will discuss the insurance provided by the ECGC to the exporters. Okay, in the next session we will discuss that how the insurance provided by ECGC to the banks. Okay, so so let's start. See friends, the basic idea we know that ECGC is mainly for providing insurance to the exporters, okay. So in case if there is difficulty, suppose exporter has shipped goods to the other country, but due to some war or some political scenario, if it is not if the exporter doesn't get the payment, in that case the ECGC is liable to pay because the exporter has availed insurance from ECGC. Okay, that is mainly the concept of ECGC. Okay, and why ECGC started in India? To promote the export business. The ECGC has been founded in the India. The foundation of ECGC is based on only to promote the export. Okay, now see, very first we will discuss some basic risk here, which is a part of your syllabus. Very first, what is the buyer risk? So friends, remember, it is not buyer's risk, it is just a buyer risk. Okay, it is a buyer risk, and note, the buyer risk is always faced by seller. How to remember? Just remember, buyer risk is faced by the seller. Faced by seller means what risk seller can face? You can just you can easily remember. See, the risk of the buyer, that a buyer is not accepting the goods, or buyer is not paying, or it may be a credit risk. That is the risk faced by a seller, it is called as the buyer risk. Very easy. And vice versa, the risk which is faced by a buyer, it is the seller risk. That means seller is not shipping the goods after receiving the advance payment, or shipping the poor quality of the goods, or shipping the goods after some time, that is a delayed shipment. That is called as the seller risk. Because who faces the seller risk? Just remember, seller risk is faced by buyer. So you can easily judge what type of risk that buyer can face. That seller is not that is exporter, that is a seller. Exporter means a seller. That exporter is not shipping the goods after even the payment, or the quality of the goods is poor. Okay, in this way you can remember. It is very very important that you should remember buyer risk is faced by seller and seller risk is faced by buyer. Okay, just remember that keyword, then you can easily judge that what type of risk is there. Okay, now third is the we have to discuss is the shipping risk. So it is very basic. Shipping risk is due to the shipping companies. It is due to the shipping companies. For example, or it may be due to the handling agents like port authority, local transporter, loader, unloader, right? So that's why it may be delay, or there may be a non-shipment of a good due to the several reasons like human error or system failure. These are called as the shipping risk. It is very easy, just to go through it. Okay, but one thing you have to remember here, buyer risk is faced by a seller and seller risk is faced by the buyer. Okay, and now the next important, see here, the risk in international trade falls into the following categories. It may be a credit risk, legal risk, country and a political risk, operational risk, or exchange risk. That are some major types of the risk which the importer exporter faces in the international trade. Now see, one by one we will discuss the important one. What is a country risk? So we have already discussed the country risk in our first chapter. Okay, and the second chapter also, risk and derivatives. So friends, the country risk, see, in the international trade, the chances of loss caused by events in a particular country. What is a country risk? The loss that exporter may occur due to the events in the particular country, which are beyond the control of a buyer or the seller. For example, suppose there is India and there is a Pakistan. See, if in Pakistan there is a coup by a military. Coup means taking over the charge of the country. That if the Pervez Musharraf has taken the charge of Pakistan, and he become the prime minister, right? If there are some internal events in other country, then trade may be stopped between the two countries. Like for example, internal rebels. If internal rebels in the Pakistan, then there may be chances that trade between India and Pakistan will affect. Such a risk is called as the country risk. Okay, particular event in the country. Now see, one important thing you have to note here, RBI has given specific guideline as per which banks are required to have their own country risk policy. That means they will ask you in the true or false, bank are required to have their own country risk policy, true or false. So it is a true statement that the banks having their own country risk policy, that bank can decide. Okay, now, and in case there are suppose small banks which are not able to formulate their own country risk policy. If the bank is small and it is not having the capacity that it cannot formulate the country risk policy, in such a cases, see, in cases they are not equipped, if the banks are not equipped to do so, they can follow the ratings of ECGC, who have classified countries into the 7 categories. So remember here one important MCQ, that ECGC have classified country for the country risk into the 7 categories. It is also called as the 7-fold classification. Okay, and also one important line we just discuss here, banks are required to make a provision in case of exposure by way of a balance abroad, deposit placed abroad, investment in the bonds, debenture, overseas lending in the corporate and trade finance, which is 1% of or more of its total asset. Okay, so basically what are the investment bank do abroad? There should be a provision, there is a provision that if the bank is if the bank is investing abroad, the 1% of its total asset should be held as a provision. Okay, one minimum 1% or 1% or more. Okay, so come to the back to the classification. I have already told you that ECGC has classified the countries, that is that is called as the 7-fold classification for the country risk purpose. Okay, so what based on what it is the classification is based on the various economic and the political factors. Okay, we don't need that what are the factors, but just remember that ECGC has classified the countries into the seven types. Okay, and what are that types? Okay, it's very important, friends. See, A1, A2, B1, B2, C1, C2 and D. These are the 7 types. Very easy to remember. Now, so see here, A1 is a insignificant risk, A2 is a low risk, B1 is a moderate low, B2 is moderate, C1 is moderate high, C2 is high and D is very high. So how to remember that? See here, just remember, you have what you have to remember, see, total are 4, so 3 above, 3 below. Just remember that fourth is the B2 and it is the moderate, so when you go down, risk will increase. Okay, just remember that fourth number is moderate for B2. Okay, then see how we know after B2 there is C1, C2 and D. Okay, so after moderate risk, just use the word moderate high, then use high, then very high. You can easily remember, and vice versa do the same for the above. For example, moderate risk when you go upside, the risk will goes down. So moderate risk, then moderate low, then low and significant risk. Okay, in this way you can easily remember. Okay, so how fourth is the moderate and it is the B2. Then you have to take a moderate, high and very high. Okay, and in the above, for the above portion, after that is 1, 2, 3 moderate we have taken, then take moderate low, and that is a insignificant risk, that means very less risk. Okay, so in this way you can remember. It is very important. Based on that 7 classification, they may ask MCQ. For example, the high risk is categorized in which type? It is a C2. In this way they can frame a MCQ. Now apart from that, one important thing you have to remember, apart from this ECGC places certain countries under the restricted cover group 1, where the revolving limits are approved by ECGC and it is valid for the 1 year. Currently the 15 countries are placed in this group. Okay, so what you have to remember that apart from this, ECGC having some groups. Very first is the restricted cover group 1 category. In this category, the limit for the insurance is on the revolving limits, that is revolving basis, and it is valid for the 1 year. And currently there are 15 countries which is placed in the restricted cover group. And also remember, there is also a restricted cover group 2. Remember, in a restricted cover group 2, ECGC in this the places the country on case to case basis. That means individual countries, particular case is decided, is discussed with the board of director, and then they will place that country in that group. So there is a case to case basis. Okay, and in a group 2 there are currently the 5 countries are placed in this group. Okay, so what we have to remember here, it is the most important part of this lecture, that classification, that 7-fold classification, we have to remember. After that, the restricted cover group 1 category having 15 countries, it is for 12 months, that is 1 year, and it is revolving limit basis. For category 2 there are 5 countries and it is a case to case basis. Okay, just remember that. Now what is the next we have discussed is that the export credit insurance in the international trade. Okay, see, if there how the insurance is important for the export business in the international trade. See, if there is a outbreak of the war or a civil war, it may block or delay the payment for the goods exporter. A coup may also bring a risk. Okay, so there may be a chances that between two countries that may be a war or a coup by a military. Okay, so it may be, there is chance that it may bring the risk, or there may be some economic difficulty in the country. Okay, and also there may be a chances of a insolvency of the seller, of the buyer, to pay the amount of the goods. That's why in such a cases we need the export credit insurance, which is basically the very basic. You can read the theory, but if there is a situation like a war or internal military coup or insolvency, at that time the seller will face the risk. So in the particular cases, that's why we need the export credit insurance. For that purpose, the ECGC work in the India, that is Export Credit Guarantee Corporation Limited. Okay, now see the ECGC of India and their role and products that we have to discuss. The mainly focus of our in this chapter is only that ECGC, how the ECGC provide different insurance to the exporters and the banks in India. Okay, now see, the ECGC provide the export credit insurance facility to the exporter and the banks in India. And always remember that ECGC stands for the Export Credit Guarantee Corporation of India. Okay, and it is functioned under the, remember, Ministry of Commerce and Industry. It is functions under the Ministry of Commerce and Industry, and it is mainly managed by the Board of Directors. Okay, and also remember a few points like ECGC is the seventh largest insurer of the world in terms of the coverage of national export, and ECGC is essentially an export promotion organization. Okay, so basically just remember ECGC provide insurance to the exporters as well as the banks in India. It function under the Ministry of Commerce and Industry, and it is managed by the BOD. Okay, what ECGC does I have already told you in the brief. You can just read that different points. ECGC is mainly for the insurance provider. It is the insurance provider for to the exporters plus banks in the India. Okay, if you want you can just read and go through the points what ECGC does. Okay, now the next, the important we have to discuss, the core of this chapter is the policies offered, that is insurance policies offered by ECGC. To whom? First we will discuss to the exporters. That means to the exporter which policies are offered by ECGC, that we will discuss. Okay, so very first policy here we will discuss is the standard policy. So standard policy is offered by ECGC to the exporter. See, the policy issued under this can vary according to the risk covered. Very first policy, it may be the shipment policy. It consists of the comprehensive risk. Second is the shipment for policy for the political risk only. Shipment policy, there is a contracts for the political risk and contracts for the comprehensive risk. The types are not important, just go through it once so that you will have some confidence. And remember, what you have to remember here, the standard policy generally covering two type of the risk. First is the commercial risk and second is the political risk. Okay, first is the commercial risk and second is the political risk. And remember, in a standard policy, the cover is 90%. Cover is only 90% of the value of the export. Generally, the measure of the policy having period of a 12 month, and here also the standard policy is having period of a 12 month. And also remember that there is a waiting for the 4 months. 4 months. And standard policy do not cover the following risk. Which risks are not covered under the standard policy? You just read that risk. That is not that much of importance. Just it is read only. You can just go through the different type of risk which are not covered under the standard policy. But what you have to remember? It is issued for the 12 months and it is waiting period is 4 months. Okay, and the cover under this policy is only 90%. Okay, that 3 facts you have to remember. Okay, so standard policy we have discussed. It is 90% of the export value for 12 months and waiting period is 4 months, and it cover both the risk, that is commercial as well as the political. Okay, and standard policy do not cover. You can read that different types of the which are not covered. Okay, now next policy we will discuss is the small exporters policy, that is also in short called as the SEP, small exporters policy. Then the name itself, it is a self-explanatory, but you have to remember that it is issued to the exporter whose anticipated export turnover for the period of 1 year does not exceed 5 crore. That means the exporter whose turnover is less than 5 CR, for them the policy is issued by the ECGC is called as the small exporter policy. Remember, they may ask the MCQ that a limit for the exporters turnover to issue a small exporter policy is, so you have to remember it is a 5 crore. Okay, and always it is generally for the period of 12 months as usual. And remember here one important thing you can remember here, it is the coverage is 95% for the commercial risk and 100% for the political risk. Okay, that one point you can remember. And we have discussed in standard policy the waiting was 4 months, but in case of small exporter policy the waiting is only for the 2 months. Okay, the waiting is only 2 months. Okay, in this way comparatively you can easily remember. Okay, now the next we will discuss the shipment, that is a specific shipment policy. It is also a short term policy. Okay, what is the specific shipment policy? Remember, specific shipment, that means if we have to export, for example we have to export 50 cars, it is specific shipment, 50 number of cars of a ABC company. That means a specific shipment we are doing. For that purpose there is a specific shipment policy. Okay, so see the cover it provides the cover to the Indian exporter against commercial as well as the political risk in the export of goods on short term credit and not exceeding 180 days. Okay, the short term policy, the specific shipment policy is only for the 180 days credit. Okay, just remember that. And remember, exporter can take cover under this policy for either shipment or a few shipment, that means to buyer under a contract. That means the policy, it may be for a specific shipment, either a shipment or a few shipment. That means you can cover either 200 cars or 500 cars. It is choice of a exporter. Okay, so that's why it is a specific shipment policy. So just remember, it is for not exceeding the credit of 180 days. That's why it is called as the short term. Okay, because there is a limitation on the credit. Okay, that is not that much of importance. So let's discuss what are the different types of the specific shipment policy. ST, SSP means specific shipment policy, and ST is for the short term. That's why it is written as the SSPST. Okay, now see there are different types of the specific shipment policy. Very first is the specific shipment for commercial and the political. Second is only for the political, and third is political plus insolvency and default of LC opening bank. Okay, so these are basic 3 types. You just go through the types. We don't need to that in a detail how that policies are there. Just go take overview, just read the names. Okay, now the next we will discuss the exports, that is specific buyer policy. See, The name itself, it is a specific buyer. That means there is a suppose we are exporting from India. There is importer in India. For example, take a Microsoft is importing some softwares from India. So Microsoft is a specific buyer. It is a specific buyer in the USA. So the insurance cover provided for such things are it is called as the export specific buyer policy. It is the specific buyer policy. And see here, it provide cover to the Indian exporter against commercial and political risk involved in export of goods on short-term credit to the particular buyer. When you listen the word or read the word particular buyer, so that's why it is a specific buyer, particular buyer policy. Very easy. And it is also having three types. First is the buyer wise, which cover commercial plus political, buyer wise only political, and buyer wise insolvency, default of LC, opening bank, and a political risk. So that the three subtypes are not that much of important as the exam point of view, but I have given some the detailed theory. You can read if you want. Okay, you can just read once if you have a time, but I think it is not that much of important. So if you want, you can just pause the video, or a PDF is also provided to you. You can read that stuff provided here. Okay, so see here, we have discussed the very first specific buyer policy. The next policy we have to discuss is the buyer exposure policy. So what is a buyer exposure policy? It is very simple. Particular exposure, the exposure to a particular buyer. The name itself, it is a self-explanatory. You are exposing, that means how much you can expose to a particular buyer. That is the buyer exposure policy. Okay, now see, there are different types of the exposure policy. The types are important. There are different types of the exposure policy. Very first is the exposure single buyer policy. That means you are taking the policy for exposure to the single buyer only. And second is the exposure to the multi-buyer policy. That means you are taking insurance from the ECGC as exporter for the multi-buyer. That means many buyers are there to whom you are exposed. Okay, so there are two types for the exposure policies. For a single buyer policy, the risk is on specified buyer. Specific buyer is there, and in case of multi-buyer, the all buyer risk is covered. Okay, very simple keywords. Now see here, the exposure single buyer policy. It is only for the selected buyers. Rest theory you can remember. For example, the cover for LC opening banks are available for the banks with world rank up to the 25,000 as per the latest Bankers Almanac. Okay, these are some lines, you can read it, but they are not that much of important. Okay, so second is the you should remember, you should understand the concept behind the policy. Okay, exposure multi-buyer, that means all buyers exposure is covered in this. Okay, it is also for the LC opening banks are also available for the banks with world rank up to 25,000 as per the latest Banker Almanac. Okay, but one thing you have to remember, the highlighted, the bold part that is very important. See here, in case of exposure multi-buyer policy, the loss limit in respect of individual buyer or a bank is restricted up to the 10% of all. Okay, so just remember, in case of a multi-buyer, the limit is 10%. Okay, in case of a multi-buyer policy, multi-buyer exposure, there is a 10% of all. That limit in respect of the individual buyer or the bank is 10% of all limit. Is 10% of all limit. Okay, that you can easily remember. Now the next we have to discuss is the export turnover policy. So what is the export turnover policy? See, the turnover policy is basically the turnover policy. That means what is the turnover of exporter? Based on that, ECGC gives the policy, and that policy is called as the export turnover policy. Okay, see, the turnover policy basically it is the variation of a standard policy. We have discussed in the beginning standard policy political as well as commercial risk is covered, and 4-month waiting and issued for the 12 months. Okay, these are some basic facts, and coverage in standard policy was 90%. Okay, that we have already discussed. But here remember, the turnover policy is a variation, is nothing but the variant of the standard policy, and for the benefit of whom? For the large exporters who contribute not less than 10 lakhs rupees per annum towards the premium. That means what? If the exporter has availed the policy, that is a standard policy, and in that if the exporter is paying a premium of 10 lakh per annum, 10 lakh per annum, then that exporter is eligible, to have a export turnover policy. Okay, now see, therefore all the exporters who will pay the premium of 10 lakhs in 1 year are entitled to avail it, and it is also for the period of 1 year like a standard policy. Okay, that is the basic. Rest things, if you want, you can read through the PDFs, but the important part that which I want to highlight is only that remember, export turnover policy is the variation of the standard policy, and the exporter who pay more than 10 lakhs rupees premium per annum, those are only entitled to avail the export turnover policy. Okay, now the next that I want to bring your attention, that next is the consignment export policy. So what is a consignment export? See, where the goods are shipped and held in stock overseas, that means the stock is held abroad and ready to sell to the overseas buyer as and when orders are received. In a consignment export, that means suppose here is an exporter in one country, there is an importer in other country. What exporter will do? Export will ship the goods to the exporting country in the warehouse and place in some warehouse. That means if the order received from the importer, immediately he will dispatch from warehouse to the importer. Okay, so in this way there is a pre-arrangement, that is already shipped goods are there, that basically consignment, that is called as the consignment export. That is called as that, the things is called as the consignment export. What is a consignment export? I have already explained here. This is called as the consignment export. The goods are already shipped. If order received, then it will immediately transferred and shipped to the importer, because the time will save from country travel. Okay, it is already shipped in the importer's country. Okay, that's called as basically a consignment export. Okay, now we come to know what is a consignment export. You just remember, there are two policies available for the under the consignment export. First is the consignment export for the stock and holding agents, and second is the consignment export for global entity policy. Just remember, just go through once. There are two types of the consignment policy. Just remember, read the words, you can easily remember. It is not that much of important that should mug up. Just remember, just go through it once. Okay, now the next is the IT enabled services policies for a single customer. SITs, that is IT enabled service policy. That is IT enabled services for a single customer. Okay, that's why it is a yes. Okay, now it is very easy. The name itself, it is a self-explanatory. The product which are under comes under the software category or IT category, for them there is also insurance provided by the ECGC. Okay, so that's why it is the policy cover for the software product. For the software, it is called as the IT enabled services policy for the single customer. Okay, and remember the tenure we know in IT, the tenure, it may be a week, month or quarter. It depends on the how much time you are required to delivery, because in IT we know how it is export is occurring. Okay, it is on online basis. Through the internet they can transfer the softwares, so it may be for a week, month or a quarterly basis. Tenure, it is very less tenure because we don't need to ship the physical goods. Okay, it is very basic. But remember what you have to use, remember here in IT policy, one policy for one buyer is issued for 12 months. Okay, we know generally policies are 12 months, for the 12 months, but one policy for one buyer is issued for the 12 months. And see, commercial risk, that is or buyer risk, political risk or LC opening bank risk are also covered in this policy. And remember, the maximum cover is 80%. The maximum cover is 80%. And remember, if there is a no claim received for the insurance, then there is a bonus that is called as no claim bonus. It ranges from 5 to 50% in case of SITs. Okay, you can remember that keywords. And next important we have to discuss is the policy for SME sector, that is small and medium enterprises. Policy for the SME sector. See, both the risk, that is commercial as well as political, are covered under this policy, and period is also generally a 12 month, we know, and the cover is a 90%. Cover is a 90% of the value. And who is eligible? The exporter who qualified under the MSMED Act 2006 are eligible to have this policy. Okay, very easy, basic. Now we have completed, here we have completed, what we have completed? The insurance policies available for the exporter. That part we have completed. Okay, that is the ECGC policies, schemes for the exporter we have completed. In the next session we have to discuss export credit insurance for the banks. Okay, for banks, how bank, if we know there is the exporter may avail the pre-shipment finance or the post-shipment finance. Who provide that? Banks provide that pre-shipment and the post-shipment finance. So banks are also under the risk. Okay, so that's why the ECGC provides some insurance to the banks, so that banks can easily lend their money in the form of pre-shipment or the post-shipment to the exporters. Okay, so that export business will increase in India and we will get a foreign currency. Okay, so for that purpose it is very important for the growth of Indian economy. Okay, so that's why it is also important to discuss the different credit insurance provided by the ECGC to the Indian banks. Okay, and that we will continue the discussion in the next lecture. So before that I have to remind you that you have to subscribe our YouTube channel Bankers Zone, and you have to join our CAIIB group for discussion. For that it is on the Telegram. You can search on the Telegram CAIIB Bankers Zone, or you can search @CAIIB BZ on the Telegram. Okay, and there is also Android app available in the Play Store. You can download Bankers Zone CAIIB app. Okay friends, so we will continue the next part in the next session.